Hi everyone, I'm Ross from Hive Business, and this is Simon, also from Hive Business. Simon is Hive's chartered tax accountant.
Hi there, everyone.
Hi there. We're here today to talk to you a little bit. Well, probably not something that's immediately come onto your radar yet, but hopefully it's a fairly obvious consequence from everything that's happening in the world outside at the moment, and the massive amount of money that the government has invested into supporting the economy at the moment through furlough, governmental support schemes, um, has a consequence. So we're here to talk about tax and how it will be changing in the future. That's certainly our strong assertion. I think you agree with that, Simon, don't you?
Yeah, definitely. I mean, the cost of paying for COVID is crazy. It's predicted to be about 300 billion. That's a massive number. I suppose to give it some context, the government planned on borrowing 55 billion when they announced the budget back in March. By the end of May, they'd already borrowed double that. So the costs are just rocketing, and it's got to be paid for, and it will be paid for through tax, partly.
I've been looking at it quite a lot, and obviously, I can't imagine they're going to ignore the situation. That the three kind of mechanisms that we usually see to solve this is to cut spending, which is a massive kind of political question, which I don't want to get drawn into now. To increase income, or inflation, which causes its own kind of problem. So, we don't necessarily have the authority to talk about two of them, but it seems inconceivable to me that there won't be massive tax increases to try and sort out some of this problem.
Yeah, I think they'll use it as an opportunity to bring in some changes that they would have never got away with before the need to do this, basically. We're seeing some things that's certainly on the horizon, particularly capital gains tax is being looked at by the Chancellor. He's having a consultation conducted on how that can change at the moment, whether it's fit for purpose. It's a relatively low take tax. It brings in about 9 billion a year, which is peanuts. We just talked about 300 billion needing to be spent this year. So it's an obvious target for changes, especially considering it was at a much higher rate than it is now.
It's always been a relatively low attention tax, hasn't it? Because they wanted to stimulate kind of entrepreneurship. But for me, it kind of feels like it's a tax. If when you sell your business, you've got a lump of cash in your hand, so it's a relatively kind of painless tax to take, so to speak.
Yeah, I mean, we've already seen them scrap entrepreneurs relief. I say scrap, they've cut the limit from 10 million to 1 million. I wouldn't be surprised if they do scrap it to the next budget or drop it so that it's almost negligible. But there's lots of transactions that aren't in capital gains tax that I think we might see in capital gains tax in the future. One of the things they're specifically looking at is tax on selling your home, which would be a massive change.
So on selling your primary residence?
Yeah, primary residence relief, which means that if you sell your house, not a second property, but your home, that's exempt from capital gains tax at the moment. I don't think that's going to be exempt for much longer.
I think that might be the case in America, actually.
Not sure.
So what's the current rate of capital gains tax then?
For most people, higher rate taxpayers, capital gains tax is at 20%. It's 28% for sales of residential properties, so that's rental properties. It used to be 28% for everything. I wouldn't be surprised if it goes back to 28%. You're probably familiar with a 10% rate. That's what Entrepreneurs Relief gives you. Again, profits of £1 million at the moment could be cut to something like £100,000. It could go all together.
Do you think there are people selling at the moment who are probably going to creep over that 10% threshold without perhaps realising it at the moment then?
I would have thought so, yeah. It's not hard for dental practice that's been in the same ownership for a number of years to be pushing £1 million. Harness the director's loan account advantage, the kind of tax-free IOU that existed on incorporation 5 or 6 years ago. They've probably used most of that limit already. or a good chunk of it, certainly.
Oh, I see. So there could be people out there who have used up their entrepreneurs relief without realising it.
Yeah, no one really had to worry about it when it was £10 million, but now it's back to £1 million. There's a lot of people pushing it.
Well, that for someone who's perhaps selling their practice, then there's quite a difference in chunk taken, where they thought they were probably going to get 10% tax, and actually they could be facing 28% tax if the government changes it at a drop of a hat shortly.
Yeah, absolutely.
Wow. Any other pockets that you think they might look at then?
I think we're going to see some changes to national insurance, probably some fairly sweeping changes to national insurance. Again, stuff they would never have got away with politically 6 months ago. Chancellor announced or kind of had a subtle dig when he was announcing some of the self-employment support. Some people, depending on how you employ yourself or how you work, you pay more or less national insurance, potentially for doing the same thing as someone else who just happens to structure things differently. So I think that we're looking at trying to equalise national insurance a bit. It's a lot higher for people who are employed. It could be costing about 20% for an individual. By the time you factor in the employer's contribution, self-employed individuals could be paying themselves about 12% in national insurance, and people paying themselves with dividends paying themselves nothing. There's no national insurance on dividends. That might.
But they already tried to have a pretty significant dig at self-employment, not by kind of changing the rates as you're alluding to there, but just by trying to wholesale change people's classification of self-employed, so that IR35 is the label that some people have.
Yeah, they've not liked it for a long time. They don't like. They would prefer everyone was employed.
Why is that?
Because of the extra national insurance they charge on employment. So the self-employment and employment status is something they've looked at for a long time, particularly where people have worked through a company and paid themselves with dividends and paid very low taxes. They've looked to introduce rules to force them down employment tax routes, successfully or unsuccessfully, depending on how you look at it. There's constant court cases on it.
Are you happy enough with associate dentists' self-employment status at the moment?
Yeah, associates working with the model kind of BDA contract have a dispensation with the with HMRC that they are self-employed, so they're safe, for want of a better word. The caveat being that you have to be working under the terms of those contracts. You can't just have that contract in place but operate completely separately. So it will come down to facts. In fact, there was a tribunal case towards the end of last year for an associate dentist that found in favour of the associate being self-employed. So that's a really good piece of evidence. Hygienists is a bit of a grey area. One of the big factors is whether the individual is able to control their own work, and do hygienists operate with the correct level of autonomy to be able to do that. I think it's not quite so obvious.
Yeah, I think if you had self-employed hygienists, you really want to kind of look at it at this moment. That's my kind of opinion on that as well. So we're starting to rack up the little areas they might attack at this moment. Anything else that you think you've got on your score?
Yeah, we've long heard, certainly in the last 12 months, there have been rumours of revisiting inheritance tax, which is obviously the tax you pay on death, basically 40% of your estate above £1 million. It's a very old tax. They are looking at ways to rework it, and what we're hearing is that it might be scrapped and replaced with a wealth tax, which is inherently risky, I think.
I suppose it's like an inheritance tax, but they won't have to wait until death to get the tax then.
Absolutely, yeah. I guess one of the main problems with that is how they would implement and run that. It's full of risks.
It is a bit inconvenient for someone having to die before they get their tax bill, though, isn't it?
Yeah, and you can't refuse to pay it then either. One of the inherent problems with a wealth tax is that assets don't really have a value until they change hands. And at the moment, when your assets change hands, they get taxed through capital gains tax anyway. So how do you value someone's wealth while it could just essentially be a piece of paper? It's going to have to be very complicated legislation to try and capture all the loopholes that they predict or may predict will exist.
Wow. Well, I mean, there's probably going to be more than even the kind of the strong three that you're looking at there. But can anyone do anything about this then, or are we just a passenger in the?
There are things to do. I mean, throughout the COVID period, we've had loads of kind of interest from dentists who have obviously had time to sit and think about their financial affairs. What we're seeing is a lot of people paying a lot of tax because they've missed out on the really easy things that do exist. Incorporation is a classic example. Many people have paid hundreds of thousands of pounds of tax in the last couple of years because they haven't incorporated. And it's an easy thing to do. There's so many ways to grab a few percentage points on tax, and it all adds up.
You're still seeing people who perhaps don't have a limited company then?
Definitely, yeah. A lot more widespread than we would have thought. It kind of seemed a few years ago that maybe the door was shut on the benefits to incorporation, but that's absolutely not the case. We are seeing people who haven't incorporated because the favourable IOU, the director's loan account I mentioned earlier, some of those rules changed, and on the face of it took that away, but in the right circumstances that's not the case at all. And that's
I think there's still options where you can get a tax-free director's loan account.
Yeah, it depends on a number of things, and we can work through it with clients and see if the numbers stack up for them. But it's possible to have your company owe you a significant sum of money on which you can draw profits tax-free.
Wow.
I guess whatever changes do come in, the one thing we know is incorporation is always going to be more flexible than self-employment. So whatever rules come in that seek to tax dividends, for example, or increase national insurance on dividends, perhaps, there's ways to optimize your personal expenditure and your company expenditure so that you've reduced your dividends. You've reduced not only income tax, but possibly the new national insurance, if there is a new national insurance.
Wow. So you're kind of saying it gives you significantly more choices, really?
Yeah. I mean, the main difference is that as a self-employed individual, you are taxed on the profit you make, regardless of how you spend that. As a company, that's not entirely the case.
Wow. But so you're still seeing people who aren't incorporated then, and still coming to your doorstep with massive tax bills. And do you think why do you think this is? I suppose I
think, kind of as I alluded to just now, the rules did change on incorporation a few years ago. In fact, a number of rules have changed. So forming a company became less attractive, and the tax rates on dividends became less attractive. And that's led many advisors to kind of just take a binary approach to it. Incorporation just isn't worthwhile. But actually, that is a very narrow view to take, and I would disagree entirely. Like I said, there's flexibility. There's so many more options that incorporation gives you, right the way through from pension contributions to electric vehicles to insurances, life insurances, that kind of thing. But you can take them out of your personal sphere into the company sphere, optimize things, save some tax, but live the same standard of life, and flip things on its head and use the company as a pension, use it as an investment vehicle, reduce your personal asset holdings. It's a different way of looking at things, but there's so much tax to be saved.
So what are you talking about there then? So that's not sort of trading as a limited company anymore?
No, that's correct. One of the biggest tax hits from a company is when you take that cash from that company, but you don't have to always take the cash from the company. So our strategy with these things is to have a look at your personal income, optimize your extractions from the company so you're only paying dividend tax and the new national insurance on what you take. Everything else can sit in the company and be a bank account for your future. basically. So if you wanted to extract loads of money to get a mortgage on a new rental property, actually the company could just buy that for you, and then you haven't paid that dividend tax. You can take that income out in retirement at lower tax rates in the future, rather than taking it all as a lump sum now.
So you're kind of not saying you have to live off any less. You're just saying you pay for it out of a different pot.
Just be a bit smarter with it. Yeah. I mean, there's no point paying 30% tax on income just to put it in an ISA because someone told you an ISA is tax-free. Saving the cash in a company saving account just immediately saves you 30%. You aren't going to get a return investing that anywhere else that high. Companies also, what we're seeing is people starting to think about using that kind of asset holding company as intergenerational vehicle to begin to pass wealth to the next generation outside of the sphere of inheritance tax as it currently exists, and minimizing capital gains tax.
Wow, so like you can pay your kids to a certain extent then?
Yeah, or you business shares or cash or properties. You're gearing up to pass them down to the next generation when the time comes, while still retaining control of them. So
it's possible income tax savings and possible inheritance tax savings, and presumably CGT as well.
Yep.
Wow. A thought flashed through my head then, because it seems like there's a lot of kind of nuances and subtleties that can easily be overlooked, and I think it's probably easy to kind of just sideswipe and put it in the box of doesn't work anymore. But I'm certainly not kind of hearing that message from you, and the bits that I'm involved in as well. I'm definitely seeing that kind of trend. I imagine there are going to be people out there who've got an NHS practice as well. Is that a deal breaker for them because they got an NHS contract?
Not at all. No, there's ways to incorporate an NHS contract with or without the NHS renegotiating that contract with you. It's not a stopper. It's not a blocker.
Wow. So plenty of things can be done then, really. Still, that's what you're saying.
Yeah, absolutely. There's so many things that people are missing out. So, they might just grab a percentage point here or there on tax, but it will all add up very quickly.
Wow. Okay. Anything they can do?
My recommendation would be to very strongly look at incorporation in the short term. The flexibilities that it gives you, I would be surprised if there isn't some tax that everybody can save just by incorporating.
Great stuff. Well, if you do want to get in contact, I'm sure Simon's happy to kind of look at an overview of your circumstances, aren't you, Si? Yeah,
absolutely. We can. We've all been using Zoom for the last 6 months. I don't say all as in everyone here at Hive. I think the whole world has been using Zoom for the last 6 months. So that's not a problem. We're happy to arrange a consultation with you.
Great. Well, get in contact if you want to discuss any of the bits and pieces. And thank you for watching from both myself and from Simon today.
Thank you.